Hello, everybody. We're going to get started in just a moment. We'll give everybody a moment to get squared away, and then we'll kick it off. 1 minute. Hello, everybody, and thank you for taking time out of your busy day to join us. My name is Josh Lipson. I'm with Alpine Brokerage, and I'll be your host today as we get ready to kick off November, which is Long-Term Care Awareness Month. So why November? November is Long-Term Care Awareness Month because it's the start of the holiday season. It's the time of the year when families get together. Maybe it's been 2 years because of COVID. But it's the time of the year when adult children go home and realize their parents aren't getting around as well as they used to be able to. Maybe they notice, mom or dad having trouble getting out of the chair. Maybe it's getting up and down the steps. Maybe bathroom takes a lot more effort because the toilet seat is too low. But it's oftentimes this time of year that families engage in long-term care conversations. In fact, the 2 months of the year that have the highest new claims are December and January, and that's a direct reflection of families getting together and talking about long-term care. So first, let's talk about why long-term care is important to you. So, listen, long-term care protects your relationship with your client. You may have sold them something or be providing them a service, but if you provide the long-term care solution as well, essentially you block out the additional advisors that are going to reach out to your client, approach them over the years, and try to sell them that solution. In addition, long-term care is an excellent way to bridge the generation gap from parents to children. From a wealth management perspective, most of the money leaves the advisor when the spouse passes away, and particularly when the second spouse passes away. And that's because the children who get the money, they have a relationship. So one of the things that long-term care can do is bridge the generation gap. Those children become your clients. They buy insurance. They have the wealth now that you can basically manage. So, these are just a couple of reasons why long-term care is important to your business, whether you're an agent or an advisor. And today it's my pleasure to introduce our guest, Glenn Usher. Glenn is Vice President of Long-Term Care at Lincoln's MoneyGuard team. He's a tremendous partner here at Alpine, and his focus is on helping financial professionals sell long-term care solutions that reduce the impact of long-term care expenses on their clients' assets and their legacy. He holds a Series 663 and insurance license, as well as a certification in long-term care. Glenn and his team, are really working partners, side by side with the team here at Alpine to help make sure we're delivering the best solutions for your clients. So I'm very excited about today's webinar. We're going to discuss why clients should plan for long-term care, how to have the long-term care conversation with your clients, MoneyGuard, industry-leading product on how to solve the long-term care problem, and then we'll go through several client profiles of those who are buying long-term care solutions today and how MoneyGuard can be designed to fit their life situation. So here's the call to action for today's webinar. While we go over these client profiles, write down the names of those that come to mind. After the webinar and during our follow-up calls, we'll talk about those clients and we'll show you how these solutions can help you protect your clients' assets and their legacy. Before I turn it over to Glenn, I want to thank you all again for your time today and let you know that after the webinar, we'll be sending you the Alpine Long-Term Care Advisor Toolkit, which includes a number of items to help you have the long-term care conversation with your clients. Items such as a long-term care client presentation, a fact finder, and Long-Term Care Awareness Month social media campaigns consisting of 8 posts. If you have a compliance department, please be sure to confirm which social media sites you can post these on. So today's presentation will be recorded. I'm going to ask you to write down your questions and reach out to us at Alpine Brokerage afterwards so that we don't interrupt this recording. And without further ado, let me turn it over to Glenn. Glenn, thanks for being here today. And before we jump in, why don't you give us a few thoughts on what's going on out in Washington State, and then we can jump right in. So thanks, Glenn.
Absolutely. Thanks, Josh, for that intro. And I think this year, the last 2 years, really, I think we've had a microscope on the LTC industry that we've just never had before. So, last year was folks becoming much more aware and in tune with their own health, seeing family members deal with COVID and kind of that scare. This year, to your point, has been all about the state of Washington. They're the first state that's actually introduced and are in the process of implementing a long-term care, publicly funded long-term care for its residents. So I actually cover the state of Washington, so this is something that I followed pretty closely. And if you're not, in the Pacific Northwest, or if you don't have clients there, this is going to be impactful because there are at least 11 or 12 other states that are looking at doing something similar. So what did Washington do? Washington decided that the state's Medicaid system was frankly being eroded very, very quickly for folks that are ultimately spending through their assets when they're on long-term care and then relying on a program like Medicaid, which is really not built to sustain long-term care claims. So what the state of Washington did was come together and develop this Long-Term Care Services Act, which is establishing a publicly funded program, and that's funded by W-2 employees working in the state of Washington. So it's a payroll tax that's uncapped. It's 58 cents for every $100 earned. So, those that are disproportionately impacted by the tax, think of younger folks, healthier folks, higher earning folks that are going to be paying more into the system for a longer period of time. And when you look at the availability of benefits, it's a really small pool of benefits that individual folks have access to. So there was a lot of pushback when this was first rolled out. And what the state of Washington did was afford Washington residents to say, okay, well, listen, if you go out on your own and purchase a private long-term care insurance policy that's protecting yourself, you can opt out of this public program forever. So you'll never have to pay the tax, but you'll also be prohibited from ever tapping into benefits. That happened earlier this year, probably early summer. And we've seen a mad scramble in the state of Washington where folks are now really going out of their way, trying to purchase these private long-term care insurance policies to get out of paying that payroll tax. So that tells us a couple things. Folks are more in tune with the impact of taxes and how that impacts them to what a potential long-term care event in the future might do. And there's a triggering event that usually is going to lead to a client making a decision. So I think that's really what today's presentation is all about, is the LTC 101 conversation. So what is long-term care, and how do we dispel some of the common misconceptions around long-term care? And then more importantly, how do we engage clients in a conversation where we're not coming off as selling something. We're really trying to position something and educate clients on a topic that frankly most people just don't know too much about. I mean, when you think of the words long-term care, to most people it's going to have a negative connotation. They're immediately going to think of somebody receiving care in a nursing home or end of life care. Long-term care, as we'll review today, is everything from just losing independence all the way up to that full-scale nursing facility. So we're going to talk about how to have the conversation and a few different client profiles of folks that we're having this conversation with, and how those conversations resonate, depending on where those clients are at in their financial planning process. Lastly, I'm just going to run through a quick case study highlighting Lincoln's MoneyGuard Solutions, our MoneyGuard 3 contract. Lincoln's been around for over 30 years. It's a hybrid long-term care strategy, so I'll walk through the ins and outs of that as well. But I think kind of starting where Josh left off is, why plan for long-term care? Well, it's important that clients understand what long-term care is. And the IRS defines long-term care as a chronic illness that requires substantial assistance to perform either 2 out of 6 activities of daily living. And you can see those listed here. These are the activities that I think most of us, if we're fortunate enough to be healthy, we take these for granted. When we wake up in the morning, we get out of bed, that's transferring. We go to use the restroom, that's toileting. We hope we get there in time without any accidents by maintaining continence. Then we bathe ourselves, we get dressed, and then we make ourselves breakfast, right? So as clients age, their independence is kind of put in check. They might not be able to do all of these without substantial supervision. So if they're unable to do 2 of those 6, that's what would trigger a long-term care event. On the other end of it, there's the severe cognitive impairment. So think of your Alzheimer's diagnosis, your dementia diagnosis, where not necessarily a physical impairment, but it's going to be a detriment to your own health if left unsupervised because of that cognitive impairment. Another big misconception around long-term care is how much it costs. So how much am I paying out of pocket? And the other is who's actually paying for it. A lot of folks think that Medicare is going to cover it or that their health insurance covers it. And the reality is that neither do. The costs for a long-term care event are going to come out of pocket, or they're going to come from a insurance policy. The last resort that most folks rely on, as I mentioned, which is what the state of Washington's going through, and again, there are about a dozen other states going through it, a lot of folks spend through their own assets and end up relying on a program like Medicaid, which is already underfunded, without being priced out for actual long-term care claims. So I certainly expect this conversation and the microscope in the long-term care industry to expand over the next decade, 2 decades. But certainly over the last 5 years, we've seen a much more in tune client base that are asking about long-term care solutions than we have probably in the last 20 or so years. You see the national averages here, over $100,000 a year for a private room in a nursing home. These are very geographically driven. In the Northeast and in parts of the West, you're going to see significantly higher cost of care. I live in the state of Connecticut, where a private room in a nursing home is over $170,000 a year, and the cost to have somebody come out to the home is upwards of $100,000 a year. So you start tacking that on. If somebody needs care and they need care for a few years, you can see how quickly that can disrupt their retirement portfolio when you're looking at how are we actually funding the care outside of all of the other elements that we're going to talk about today. So when we talk about the impact of a long-term care event, we're talking both emotionally and financially. The financial is going to be what a solution like a MoneyGuard or another long-term care solution can provide. But from an emotional standpoint and from a family dynamic standpoint, those stats that Josh talked on, the most claims being filed in December and January because families are coming together, a lot of times coming from across the country, maybe they haven't seen mom or dad over the last number of years. So it is absolutely a family conversation because, who's going to provide care in the absence of a plan? Well, it's going to fall on the spouse if they're physically able to provide it, or it's going to fall on the other family. So 53 million Americans provided unpaid care in the country last year. And it's lopsided. 61% of the time that family caregiver turns out to be a female. And the dynamic and the statistics behind that are men tend to live a shorter life. Their female counterparts end up taking care of them, and then they end up being taken care of by the next generation. That's just kind of how those stats play out. So it's absolutely important that we involve not just the potential client or the potential insured in this conversation. It's really around developing a plan so everything is taken care of, not just the financial elements, but everything with the family, who's going to step up, who's going to provide care, and what are those contingencies in place. From a financial standpoint, you see the withdrawal rate that's estimated from their portfolio, 5%, which is probably already too high, more than doubling to an 11%. And keep in mind, those withdrawals that are coming are typically coming at the tail end of a retirement when you're very heavily concentrated in qualified assets, which opens up the door to potential taxes on those funds that you're liquidating as well. So when we're talking about long-term care, it's more about the stage that client is in. And when I say stage, I mean their life stage. Do they have kids? Do they have an aging parent? Are their parents taken care of? Are they moving in with them? Are they providing support? And it's also about their stage of retirement planning. Are they in the accumulation phase? Are they in the protection phase? What exactly is it about that client and their current status that's going to resonate from a long-term care planning standpoint? But the three main questions that you're going to want to ask are, who's going to provide care to the clients if they need it? So, is it your spouse? Okay, well, if your spouse isn't available or they're not physically able in 20 or 30 years, who's next? Is it going to fall on the kids? Are they willing and able? I look at my own scenario. I live in Connecticut. My parents live in New Jersey, and my brother lives in Florida. If my parents suffered a change in health overnight, it wouldn't quite be as easy to just move them down to Florida or to move them to Connecticut, or for me to kind of be jockeying back and forth between New Jersey and Connecticut. So it's not just a conversation about, hey, we'll cross that bridge when we get there, because unfortunately that's what a lot of folks do. And in the absence of a plan, it's a nightmare for the family to try to pick up those pieces. The second one you see there, where do the clients want to receive care? I can tell you from experience, nobody wants to end up in a nursing home, although about 10% of long-term care claims are paid to nursing homes, which tells us that The other 90% are provided in other care settings, like a home-based setting or an assisted living facility. So most folks want to remain in home for as long as possible, and having the funding mechanism there to make sure that clients are able to stay home and won't have to go to a facility setting is really where that third bullet comes in, which is how are your clients going to pay for care? So when we start broaching the actual subject with clients, I think there's the financial element, but then there's also the emotional element. The financial element is obviously, how are we going to pay for this? We saw those staggering numbers, and those have consistently outpaced inflation for the last 2 decades as far as the cost of care, how quickly that's rising. But some of the other elements, the care preferences and healthcare directives, who's actually going to manage that care? Most families have that one person that steps up, whether it's a spouse or it's one of the children that kind of steps up and is there day to day. Who is that person, and are they aware of that? Is the rest of the family aware of that and okay with that? And as far as decision making, who is that going to land on? So who's going to have those the healthcare directives or power of attorney? The right hand side, by far, the reason why folks are asking advisors and asking their agents now about long-term care is because they're starting to see personal experiences with it. And those personal experiences can be as simple as just knowing somebody that's going through a long-term care claim, knowing somebody that's become a caregiver for somebody and seeing the burden that it places on them, both just physically, emotionally, and financially. And then the last one there is becoming a caregiver themselves. The one bullet you don't see listed there, and it's one that unfortunately we see a lot of, is the trigger why somebody wants to talk about long-term care is because they've already suffered a change in health. And unfortunately, looking for options after that happens is going to significantly limit the options that you have access to. So, the whole concept around long-term care planning is there's the long-term care plan, which is everything that we've talked about, getting the family together, talking about the care setting, how's it going to be paid for, right? Then there's the, is there a better option out there, whether it's through insurance or some other options to say, well, how are we going to provide funding to the actual plan? So the plan is more holistic in nature. It involves everything from who's going to provide care, where do you want to have care be provided, are the family members aware of where they are in the plan, or the healthcare directives in place? So that's the plan. Then we want to talk about the funding mechanism to the plan, which is where we can explore some of the options around insurance. So when we're engaging clients in that conversation, again, having a personal story, I think, is paramount. So whether the clients have a personal story, or you as their agent or advisor having that personal story, whether it's your own personal story or something that you've gone through, or something that you've seen another client go through, and the emotional toll and financial toll that it took on them, that's obviously going to be our first entry point into the long-term care conversation, to begin educating clients really on what long-term care is, because it's not just the nursing home care that I think a lot of folks think that it is. But some other strategies, just sharing statistics around the likelihood of folks needing care, or if you, again, have personal experience with your own clients needing care, statistics about the cost. We talked about that. Talk about the risk to their portfolio if they don't have any protection in place, around how folks are having to kind of pillage through their retirement bucket at the worst possible time, and how a lot of folks do end up having to rely on programs like Medicaid, which aren't guaranteed to be there in 10, 20 years, and we already know are underfunded. The last document, or the last point there, documenting the source of funding for care needs. And I say specifically documenting. So you want to document with all of the clients that you're meeting and talking about long-term care, documenting that you're having that conversation with them. And to help in that conversation, we've introduced this tool called the asset identifier piece. And this is one of my favorite pieces that we have here at Lincoln, because it's a completely product agnostic tool. And it's not positioning insurance, it's not positioning MoneyGuard. What this piece does is really empower you to have a conversation with the client through a completely product agnostic lens. So in the top half of the asset identifier, we're quantifying the risk to a client's portfolio. So what I've done here is basically take the Connecticut state averages that I talked about earlier. So 175,000 for a nursing home, about 50,000 for at-home care. So we're educating the client in the top half. This is likely coming into play after we've already educated them around what long-term care event looks like. So how the family has to step up, who's going to be providing that. But when we get down to brass tacks of how are we going to provide funding to that plan, we see the risk to the portfolio if we have to rely on an assisted living facility or a nursing home or at-home care. And then in the bottom half is really kind of where the magic happens, because we're qualifying what their current long-term care plan looks like. Now, most folks will never have gone through this exercise, so this will be the first time that they're really exploring what their current, call it by default, long-term care plan is, which is a self-funding plan, meaning they're going to spend through their own assets or spend through their own income to pay for their long-term care event. So what most folks typically will pencil out first is that we've got X amount of dollars in our savings or checkings, or that are sitting in CDs or bonds or those lower yielding assets. Most folks are going to rely on those funds first. But once you spend through those, then you're tapping into qualified assets and non-qualified assets. Then you're eroding the portfolio even faster than the dollars that you're spending, because you have to pay taxes on a lot of those funds when they're coming out, either through capital gains or through ordinary income. Then you've got, the backup plan, which is, maybe we'll have to sell the vacation house, or, maybe we'll take a reverse mortgage out. So when you get down to it, there are some significant concerns there, both from a tax standpoint, from a leverage standpoint, but certainly from a liquidity standpoint. It's not like somebody can just sell their vacation house overnight if they have that change in health. So penciling this out on the asset identifier, empowers us to be in a position to say, okay, well, look, here's what your existing long-term care plan looks like, and here's the risks that are potentially going to impact that plan if you have a change in health. Then and only then should we introduce some of the solutions that are out there. And I think that's one of the biggest missteps that we make in the long-term care planning space, is introducing a solution to a client before they really understand or appreciate what their problem is. So unless they're educated on long-term care and the risks that it poses to them, the likelihood that they're going to need it, and how much it's going to cost, most folks are just going to write it off and say, all right, well, we'll cross that bridge when we get there. We'll figure it out when we get there. This is kind of helping them identify, the cliff ahead of getting to it, and put a strategy in place. And when we look at the alternate solutions, it's not a, do you want to buy long-term care insurance or not? But what I can tell you is most clients are going to say no. But if you're positioning it and saying, well, here's your existing strategy with the asset identifier piece here, here's what your current plan looks like. Now let's look at some alternate strategies and try to add some efficiencies into that existing plan, whether it's through tax efficiency or through leverage or some combination of those two. And that's when we get into the Lincoln MoneyGuard story. So for the last 30 years, MoneyGuard's tagline has been that it's a smarter alternative to self-insuring, or a smarter alternative to self-funding. So if in the exercise using the asset identifier, we're penciling out what their self-funding strategy is today, that's going to give us a basis to say, okay, well, can we add efficiencies? Is this the most efficient way to plan for a long-term care event by self-funding? What we found with Lincoln MoneyGuard is we have the ability to add leverage and tax efficiency into that existing strategy by using those assets that they've already earmarked for a potential long-term care event. So the story with MoneyGuard has been leverage on those dollars for long-term care if you need it in a tax-free way, a legacy in the form of a tax-free death benefit if you never need care in the future, and liquidity through our return of premium benefits. So we have a 70% return of premium and 100% return of premium benefit over a 10-year vesting schedule. So you can either look at this as the 3 L's of MoneyGuard: leverage, legacy, liquidity. Leverage for long-term care, legacy and death benefit, liquidity with the return of premium, or the old adage, live, die, quit. You get a benefit in any one of those circumstances. If you live and need the long-term care, you've got a big leveraged pool of tax-free dollars that you can tap into. If you pass away without needing it, there's a tax-free death benefit that's going to give you at least the premiums that you would put into that policy back. And if you want to quit the plan, you can get options with all or some of your money back. So it's about looking at the assets that a client's already earmarking for a long-term care event using the asset identifier, right? We've got X amount of dollars in our checking and our savings accounts, and that's probably the funds. Well, that's all well and good, but you're not getting any leverage on those funds. We're entering a period of high inflation, and we're in a historically low interest rate environment. So you're effectively losing leverage just by the nature of where those dollars are sitting. What we're positioning here is a strategy to add leverage into the existing plan that's going to remain liquid through this particular plan and provide the legacy, fully guaranteed benefits either way. So I'll quickly walk through this case study here before I jump into those client profiles. So we have Susan. She's married. She's age 55. So this is kind of right in that wheelhouse of somebody that might have an aging parent that they're starting to get concerned about, or maybe that aging parent that's moving back in with them because they're starting to lose independence. They could still be potentially providing financial support to their kids, or funding their kids' college. So Susan's in that kind of sandwich generation where she's starting to become aware of long-term care. Maybe she's become a caregiver herself. So she's looking to implement a strategy. So what she does is purchases a MoneyGuard policy. As we're going to see, she's funding $10,000 a year over the course of 10 years. So $100,000 going into it. And we're going to see the leverage that it provides on the back end. So again, she contributes $10,000 a year in premiums. You see that up at the top. The two options that you see listed are the return of premium. Over 90% of folks go with the basic, which is a 70% return of premium benefit. And you can see why, because of the higher long-term care leverage reflected there. So what you're looking at age 85, if this client was to go on long-term care claim, is a monthly benefit of $9,000 per month, which is about $108,000 a year, and a total pool of benefits available to her of $575,000. So for this client that said, hey, I'm already earmarking, my savings or my checking accounts or our CDs where we've got a couple $100,000, what we're doing is saying, well, if those are the funds that you've already penciled out, that is your long-term care plan. If you suffer from a change in health, why don't we introduce some leverage and tax efficiency to that plan? And by doing that, we're able to take the $100,000 from that bucket, reposition it into this strategy. And by age 85, we've got almost $600,000, so almost 6-to-1 leverage for every dollar that we put into that plan on a completely tax-free basis if we need it. And if we don't need it, we see the death benefit's going to pay out at $100,000, which is effectively giving her premiums back. And if at any point in time she wanted to surrender that contract, she'd have a $70,000 return of premium benefit. So it's live, die, quit, or leverage legacy liquidity. It's all about identifying a client's existing plan and just adding leverage and tax efficiency into it. So who should we be meeting with? Who should we be talking to about long-term care? Or maybe more importantly, who's more receptive to the long-term care conversation? So looking at the client profiles, there's the pre-retirees, which is where I would say that example that we just walked through is likely in. Folks that are, kind of taking care of the older generation, potentially still taking care of that younger generation with their kids, but they're on track with retirement planning. They might have just finished paying off their mortgage or their 529 plan, and now they're pivoting their focus to a more protection focus, right? So they've been in that accumulation phase and they're starting to transition over to how do we protect all of these assets that we've built up over the last 20 or 30 years. So these are folks where they likely are starting to have, friends that are going through this, or, their parents might be going through it. So they might be much more receptive to a long-term care planning conversation. The next one down, we have Kate. So this is a young professional. We're starting to see more and more of these folks. So, think of those quote unquote Henry clients, the high earning, not rich yet. So these are high income folks that are doing all of the right things with their retirement plan. They've maxed out their 401k contributions. They've maxed out their IRAs. They're utilizing all of those tax efficient investments that they have access to, but they still have that excess discretionary income where they can allocate, a few $1,000s a year over the course of 5, 10, 15 plus years to contribute to a strategy that we in this business know that, maybe Kate doesn't necessarily care about long-term care. Maybe she doesn't have experience with it today. But if she's doing all of the right things and setting herself up for a comfortable retirement, it only makes sense to talk about long-term care planning in this context, because younger folks are probably going to be more insurable, so healthier clients, so much easier to qualify for coverage. And the younger they are, the more inflation options that we can tack on and ensure that pool of benefits grows. A couple other client profiles. So you have the cash strong or the higher net worth clients. For these folks, it really does come down to dollars and cents. Higher net worth folks or cash strong folks probably didn't get there, by not making prudent financial decisions. So for those folks, it's why would I spend my own money when I can pay pennies on the dollar and have the insurance company pay for the rest of it? If I've got assets lying around that I'm earmarking for long-term care, why not just reposition it as a single deposit and get that 5, 6, 7 times leverage on those dollars and add tax efficiencies into it? And then lastly, you have Jack, who's a retiree. Obviously, they're in the protection phase, but they could have annuity income streams. They might be starting with RMD planning. So, capturing some of those income streams and immediately turning that into leverage for something that's becoming more and more top of mind for those folks. So what Josh mentioned earlier, I'm sure you have folks that fit into any one of these demographics. I think what I'll end on here before I turn it back over to Josh is, I am Lincoln's sales vice president here at MoneyGuard. I cover Lincoln's MoneyGuard products. There are a whole host of other solutions out there in the marketplace, which is really what the folks at Alpine Brokerage do all day, every day. So if you've had folks that you're thinking, fit that client profile, certainly reach out to Josh and reach out to the other folks at Alpine. Maybe MoneyGuard is a great fit for that client, or maybe Alpine has another fit. That's really what they're there for, and what we're there for is to help you navigate through the long-term care conversation and implement strategies that are going to benefit your clients down the line. So, Josh, with that, I'll kick it back to you.
Thank you, Glenn. Fantastic job as always. Most appreciated. I want to take a moment to thank everybody out there. As Glenn indicated, hopefully you were able to write down the names of 3, maybe 5 names, who came to mind during the presentation, who fit the client profiles Glenn shared with us. During our follow-up calls, we'll discuss these clients and show you how these long-term care solutions can help them protect, against the cost of long-term care and enhance their legacy. Don't forget to be on the lookout for the Alpine Long-Term Care Advisor Toolkit. That'll help you engage your clients in the long-term care conversation, as well as be on the lookout for communication from Alpine in November as we share more information on the multitude of long-term care solutions that Glenn alluded to, including using qualified accounts to fund long-term care solutions, repurposing non-qualified annuities, and legacy lock, which is perfect for safe money sitting on the sidelines in CDs, money markets, and savings accounts. So the team here at Alpine is available to help, so give us a call at 866-777-2006. Visit us on our website at alpinebrokers.com. Connect with us on LinkedIn, like our Facebook page, and subscribe to our YouTube channel. So thank you, everyone, for attending, and have a great day.